if you're going to sell your business one day, the buyer's going to ask two questions. The first question is, what is the cash flow? And the cash flow is going to determine the price of the business, as it were. The second question is, will this cash flow continue after I become the owner? And that question is going to determine whether they're willing to do the deal at all, at any price. And it's also going to dictate to a great degree what sort of terms they're going to demand in negotiating that price.
Welcome to the Profit Answer Man podcast. We believe the purpose of business is to make lots of money. We'll show you how to scale and grow your profit and cash flow, all while working less. We're a big fan of the ELF model: easy, lucrative, and fun. If you're the backbone of America, you deserve to be well rewarded for that. Listen in to see how other business owners are doing it and how to maximize your profit and cash flow. Welcome back to the Profit Answer Man, David Barnett. It's great to have you join us again.
Hey, Rocky, it's great to be here. Thanks for inviting me back.
You are most welcome. So remind everybody what you do.
So I run a consulting business where we help people buy and sell businesses. We do analysis work. We help people prepare their business for sale. We do the what's called the packaging. So we create the business profiles or SIMs. We do evaluation work. We help people advertise their businesses. But we are not business brokers. We do not work on a commission or anything like that. We are consultants. And so people pay us for each step along the way. And a lot of the times we help people with deals where they don't actually need to find a buyer. They've identified one already. They just need someone to work with who can help them through the process. And with buyers, we're helping to analyze deals, and we expand our education online. It's how we find clients. So I've got a YouTube channel. I've written several books, and we do some online education. I even have a group coaching program for people that want to buy a business as well. It's been going since 2018, actually, that one.
Nice. And I know a lot of business owners might not think about selling their business, but I am a big fan of, if your business is exit ready and sellable, it more than likely is making more money and is more than likely more fun to run, because that's the type of business people want to buy. That's the type of people we should all want to own. And so if we can get there, it just makes for better business. And should you decide you want out, or somebody makes you a ridiculous offer, hey, take it and run, right?
Well, and I'll extend that by saying this, is that the value of small and medium-sized businesses is based upon their cash flow. And the multiple of cash flow that is typically had during an exit is, quite frankly, not all that impressive. And so most of the time when I meet with a business owner and I show them what their business might likely sell for in a transaction, they'll say, hey, if I just stuck around for a few more years, I'd have that money anyway. And they're absolutely correct. And so the real benefit of owning a small business is in the years of ownership. And so if you're going to sell one day, focus on the profits today, have a plan for those profits, get them out of the business and into some other kind of wealth vehicle that you might develop. And then you are going to exit one day, but don't fall for this dream that somehow if you work really hard, that magically your business becomes worth a lot of money and you're going to be saved at the last minute before retirement with some huge generous exit.
And that's the problem we solve. We let them make money now, and then we help them remove it from their business and let it grow somewhere else, because just about every business can get punched in the face through no fault of your own, right? COVID, recession, tariff. These days they're coming faster and faster. So you just have to be ready. When you are ready and you have other opportunities, your business doesn't need to be your sole support. You can survive your life while the business rests until things change, and they always change. And then you get back to growing again. So we're here to talk about your new book, The Business Fortress.
It's available on Amazon. It's been out now for about a month and a half, I think.
Oh, nice. I already read it. So I've probably had it for about that long. Let's start off with that first thing that we're talking about. In your book, you say cash flow problems are symptoms, not causes. And I think this happens a lot. People are like, oh, I have no cash flow. I got to go sell more. I got to borrow money, which is the worst thing you can do when you have a cash flow problem. So what are some of the earliest hidden indicators of a business becoming fragile that the business owner may not even be aware of up front?
Yeah, so thanks for asking the question. This is, the Business Fortress is based upon a lot of the experiences that I've lived through in my own businesses, but also what I've seen with other people that have come to me with different issues and problems. And the hidden things that make a business more fragile are usually because someone hasn't quite worked out their business model really well, or they're choosing not to recognize certain issues. So I'll give you a quick example of someone who realized this one after just a few months. So if you pay people a commission in your cash flow forecast, you might say, hey, if I'm going to pay people 40% commission in a service business, then that means 40% of sales is going to be my cost of my employees, right? Would you say that a lot of people might come to that conclusion?
Yes, but I don't know I like that plan, but okay.
Well, I'm talking about like a hair salon or a nail salon. Like
Ah, right.
this is often the
Yes.
kind of arrangement, right? So I actually had a client who bought a business, and they came to me after this deal was done and explained their issue. What they forgot was that when you're an employer, you don't just pay your staff their salary or their wage or their commission. You're also on the hook for all of the source deductions that the government requires and vacation pay. So where she lives, this adds up to another 9%. So instead of the employees costing 40%, they actually cost, 44.5. And that extra 4.5 points of margin was almost half of the net she was planning on. And so this is just an example of how people will create a plan. And if something is missing, in this case, she was missing the fact that she had these additional costs for her staff, you can run that business for a while. And it'll take you a while before you start to realize, hey, there's something not adding up here. I'm not able to generate the cash to pay my overheads the way I thought I was going to be able to, what's going on. And I see this kind of thing all the time where people just do not have an awareness of what it really costs them to deliver their product or service. You must see this too, Rocky. You work on this?
All day long, the number
Yeah,
one thing we work on. But it's not just that 4.5%. As you're talking, I'm like, well, what about timing? Now, you're
sure.
talking about a hair salon. They're charging it then and there. You get paid, you pay. It's all relatively quick. But I deal with a lot of people in the construction industry. Oh, they go out and they do work and they pay their people. And it's a 90 to 120 days until the check shows up. So even if you can work off of the margin, you might not be able to afford to float 4 months of salary on that margin. You might need to cover that. And so that's another thing to keep in mind is when do we see the cash? And, if you talk about a commission plan, I never like to do commission on sales. We always want commission on GP, gross profit, because I want them to know if they're giving away our profits and they're discounting. Right. And I also like to pay salespeople when I get paid, not when they sell, so that this way you don't have that timing issue, because you might sell something today, and if you have to deliver, install, it might be 3-6 months till you have to collect, and especially in a long sales cycle, all kinds of things. So I want that sales rep involved until they send the check. So that's a big part of it too.
Now, there's another one that I've seen as well, which is kind of the opposite. So sometimes people in a service business, and this is an example from consulting, they actually succeeded in productizing their service. And so you must be familiar with that concept where you take a service, you make it very standard, you attach a price tag to it. So that makes it easier to sell. And so the customer says, yeah, I want that outcome. I want that deliverable. And so they pay for it, just like they might buy an object off the shelf at a retail store. And then you have to provide the service. However, the problem in consulting that productizing is supposed to solve is scope creep, which is like clients continuously asking for more and different, et cetera, and stretching the mandate. Even if you productize the service and you get paid up front, scope creep can still drag in, and you can end up with other problems. So the example that I'm thinking of, the consultant requires certain bits of information from their customers, and sometimes the customers drag their feet. And so they're making the sales and recording the sales at the time that the customer makes the payment at the beginning of the engagement. But what ends up happening is they get this increasingly larger liability of undelivered service, which is going to take time, and it kind of builds over the course of time. And then you end up in a situation where, you've got all of these people having to work on all of these files, but the money already came in, it's already been recorded, and a lot of it's already been spent. And so you end up with these off-book liabilities, which are difficult to track. And I would liken it to the airline industry and their reward points, because those companies will create larger and larger mountains of reward points in your savings account, and it represents a bigger and bigger liability for the airline. They got to deliver those flights or whatever it is, but they don't necessarily recognize the potential liability of everyone redeeming those points.
They fix that. They just make the points worth less and they less redeemable because all those
They
flights are
inflate them
blacklisted.
like a central banker, right? They just keep
Just
inflating the
just like
problem away.
it works, you know? One of the things I always like to look at with my clients is risk management. And entrepreneurs in risk management, they're like, wait, what are you talking about? We take risks. We don't need to manage them. But yet, when you look at it, it's the things you don't understand that can kind of knock you over. As you look at small business, I think most of them don't even think about it. They're too busy just trying to do their things. What are some of those things that you see that are high risk that they might not even be aware of?
Yeah, like big companies are often accused of being bureaucratic because they develop a lot of policies and have a lot of systems around different things. And one of the advantages that small businesses have is they're seen as more nimble and better able to adapt and serve their customers. But one of the key things that I see is when small businesses are just too ready to give people basically a 30-day account. Right. So somebody calls you up, maybe you've even been chasing them to do business with them for a while and you've been pitching them, and then they turn around and say, yeah, I'll place an order with you. And they expect to be given 30-day terms. But you haven't done any kind of underwriting. You haven't asked any information of them. You don't even know if they're good for the money. And worse, and I've seen this happen before, the reason they're coming to you is, guess what, Rocky? They've just been cut off by their existing supplier. Right. So it's like the last kind of customer you should want to onboard, but you're so excited about making the sale that you pursue it anyway. And so I encourage my clients to have some kind of credit policy in place. And I've seen this firsthand. When people stick to this, it works really well. Because when people say, can you ship this to us? And you say, well, we need some kind of payment. How are you going to pay? And they say, well, we'd like to have an account. You go, great. You create some kind of credit application. And you ask them for things like a couple of years of tax returns or some financial statements or things like this. And a lot of the times, those other companies are not going to want to give that to you, in which case they self-select out of your credit granting process and they revert to a credit card account. And you have to have the courage, the fortitude, and the discipline to follow a policy like this. Because, if you take on the bad customer and they don't pay, that's not the only thing you lose. You don't just lose that money. You lose what it costs you to deliver for them, the product or the service.
So what I have found is my owners are really nice people, but they usually hire somebody who will just follow the rules because that's what they do. They follow the rules. And so we don't let the owner approve credit. You got to have Sally over there do it because Sally going to do the job that you refuse to, which is to hold the credit report up until it gets done and to make sure that it's followed up on. And the other thing I have noticed is scammers are the nicest people you've ever met.
Yes.
They have to be, don't they?
Yeah. Well, the whole term con man comes from the word confidence. And so these people have to be able to inspire confidence in you to get you to basically hand over your money.
So be careful. And this is the one that this one's the funniest one because most business owners are proud of the fact that they are the linchpin of that business, right? That they take care of everything. The reality is, especially when it comes to selling, the more involved the business owner, the less valuable the business is. On top of that, they also create their own risks. What have you seen out there with the people you've worked with?
It's interesting because there's a whole list of things that people might see as risky in a small business, from customer concentration or supplier concentration, or the fact that, there's the owner deals with the top 5 accounts or things of this nature. And working in this space, I'm having these conversations all the time. A couple of years ago, I actually thought, you know what, I need to be able to quantify these qualitative things and create more of a process around it. So my team and I created something called the locus of goodwill calculator. It's based on the concept of locus of control. And we created a list of questions that have yes and no answers. And every time one of them is answered yes, it puts points into a bucket. And there's 3 different buckets. There's the owner, the business's brand, and the location. So these are the 3 places that I believe goodwill can reside. So if too many of the answers, Rocky, if too many of the answers indicate that the relationships and all the important decision making has only been made by the owner, then more points are going to accumulate in the owner bucket, meaning that there's the most of the goodwill is actually the owner's personal goodwill. And that means when a buyer buys the business, it's going to be difficult for all the positive mojo that the customers and employees feel. It's going to be difficult for that mojo to transfer over to the new owner. If the points indicate that the goodwill belongs to the brand name and the business, then it's much easier for the owner to change because many people aren't even dealing with the owner. And the other one is the location, right? And so if the location is getting most of the points for the goodwill, then it actually makes it, that opens up other questions or things that need to be pursued, such as, do we own the building or is it leased? And if it is leased, how do we make sure we have such a long lease that we're going to be able to deal with our commitments and our debts, et cetera, as with the remaining time that we have in this location?
And that makes sense. I don't think people think about the intangibles. They think about the tangibles. And yet, many times it's the intangibles where the value is hidden or unhidden, depending on the particular situation. It's a plus or a minus. But knowing what that is.
Yeah, I like to, when I'm talking with groups of business owners, I say that the buyer, if you're going to sell your business one day, the buyer's going to ask two questions. The first question is, what is the cash flow? And the cash flow is going to determine the price of the business, as it were. The second question is, will this cash flow continue after I become the owner? And that question is going to determine whether they're willing to do the deal at all, at any price. And it's also going to dictate to a great degree what sort of terms they're going to demand in negotiating that price. How much of it is going to be maybe seller financed, how much they're willing to put down, how much might be tied to an earnout based on future performance, et cetera.
People don't think when I buy a business, I have to be able to make enough business to live for myself and pay back what I paid for the business within a reasonable amount of time. And if they can't do both of those, the business isn't worth buying, whereas the owner may not have the debt service, especially not the debt service at the level that the buyer's going to have it. And they need to be able to sit in the buyer's shoes and understand what the buyer's about to do and whether or not their business can support that.
I was on a panel discussion actually the other day on another podcast, and there were two other business owners there with me. One of them said that at one point she had 4 large customers and then a bunch of small ones. And she had built this business up from scratch. She had started it. And so what happened was just after the big COVID rush, 2021, 22, these 4 businesses, they had profited from that big expansion after COVID. And they started to have trouble. And all 4 of them ended up cutting her services. And she said she had to lay people off. She had to shrink the size of her business. But here's the thing. She was able to right size her business and become profitable again by shedding some employees. And what I pointed out to her was, hey, if you had sold your business at the height and someone borrowed a bunch of money from a bank to buy that business from you, and then they lost those 4 big clients, they can't right size the loan. Like they're stuck with that payment. And this is an example of how the risks that a buyer faces are very different than the risks that an owner faces who built up a business from scratch. And a lot of the times the business owners who might sell one day, they don't truly recognize this difference that you pointed out about how different it's going to be for the new owner. And a lot of the times the people who are coming in and buying a business, they're not going to have the same degree of familiarity with the industry. I'm a huge fan of really creating an exit plan where a business owner finds someone who can succeed them and then creates a multi-year plan with that person to kind of bring them in the tent, teach them how things run, maybe start them off as a minority shareholder. And then over the course of several years, you transfer over bit by bit and then finally step back and do your deal over time. What it does is it de-risks it tremendously for the buyer because they have a more limited commitment and risk because they don't take on a big debt. And it can actually become more lucrative for the seller because in addition to selling their stake in the business eventually over the course of that plan, they also gain from the participation of ownership over the course of the time that they become an increasingly smaller shareholder. So it's actually one of the few ways that somebody could sell a business for more than quote unquote what it's worth.
Do you find that owners are scared to do that because they fear the person might come in, learn everything, and leave?
That's one of the fears. I used to have a career with the Yellow Pages. Did I ever tell you about my Yellow Page career?
I think you may have.
It was my first job out of university. And I was all excited because I thought that I was going to meet a whole bunch of like Steve Jobs and Bill Gateses when I was like driving around visiting all the small businesses and, real entrepreneurs. And one of the older guys took me aside and he said, listen, let me tell you who we deal with here. And he said 30% of business owners own a business because no one will hire them. Another 30% own a business because they won't work for somebody else. And another 30% own their own business because they can't keep a job. And he said all three of those groups sound similar, but they're very different. And he said the last 10% are people who see an opportunity in the marketplace and believe that they can deliver at a reasonable price and win market share from other people. And they actually create a plan to start a business. And it's that 1 in 10 person that really looks at their business as a cash flowing asset. And they're willing to listen to podcasts like the Profit Answer Man, and they're willing to work on things, and they're willing to create a plan. And that kind of person is going to be more open to potentially looking for that right candidate, because now you're starting to talk about, instead of a business sale or a business exit problem, it's now an HR problem, right? How do we find and hire the right person who could grow into this role and might have an interest in succeeding us as the new owner? Those other groups of people, a lot of them are micromanaging control freaks who don't want to listen, aren't willing to negotiate. So their options are going to be limited anyway. And those are the people who, after 30 years of no vacations, suddenly realize, I want to resign, I want to quit, I want to get out of this. And then they call someone looking for help to sell their business. And that person has to sell it that way, because they probably aren't going to be able to have sort of a negotiated coexistence with someone who takes over slowly over time.
I have a love-hate relationship with Russell Brunson,
Oh,
wrote
do you?
Expert Secrets. And part of it is because Russell gets everyone to buy his crap. And that bothers me. But he says in the book, he said, if you build an offer or a product for people who take action, you've eliminated 98% of the market. Meaning, he said only 2% of the people take action. You talk about 10% of the people taking action.
Well, listen, 100% of these business owners took action. I'm just saying that 10% of them are true entrepreneurs.
I understand that, but 90% of them are pretending to take action. They don't read a book. They don't learn about their business. They don't do what they should do to run a business. They're an accidental entrepreneur, right? They're running. That's what I mean. In the
They're
sense
the
of,
E-Myth technician who ended up with a business. Yeah.
Yeah. So I get it. I'm okay with the small sliver of the market because I want to stay in the fun part. The rest of them can do whatever they want, and I'm okay with that. I think that's what we get in our audience, so I'm cool with it.
Yeah, totally.
One of the things you talk about is liquidity is more powerful than leverage. Now, these days, everyone always talks about leverage, other people's money, borrowing money, all of that stuff. But at the end of the day, we started this whole thing on cash flow. Cash flow is about liquidity, right? But what have you seen with that? How is it that liquidity beats leverage?
Well, because you control liquidity. I think that's the difference, right? Ultimately, leverage, someone has to make a lending decision to agree to allow you to have leverage. And the danger that occurs is that the availability of credit goes up and down with the general economy. When times are booming, banks are more interested in lending, and all you have to do is look in your mailbox and see all the credit card offers that might be coming out. And then a couple banks go under, some bad news about the economy comes out, and then all of a sudden those offers disappear. I think that that's a great measure of understanding just how willing people are to lend. So if you depend upon credit, the credit can be turned off. And that's a risk point that a lot of people don't really consider, because they get very comfortable. People have this recency bias. And if you've had the $100,000 line of credit from the bank forever, you just assume you're going to keep it forever. But I've worked with clients who've had their lines of credit canceled. I've had, the bank will say, we're cutting your limit. That's one way they cancel it. Another way they cancel it is they just say, we're going to term it out. Your line of credit is now a term loan. You have to pay us over, 18 or 24 or 36 equal payments. We're going to turn it into an amortizing loan. And if you were someone who put your new revenues onto that line and then used that line to buy things all the time, and you were constantly revolving it, and now all of a sudden it's been stopped. It's what is that game when someone takes away a chair?
Musical chairs.
Musical chairs, yeah, the children play. So all of a sudden, now that's been taken out, and suddenly you now have to make up that gap somehow in your cash flow. especially if you're in a business where you've got certain payment terms and receivable terms with your different customers and you're trying to play a timing game. The line of credit was probably very useful in smoothing out that timing problem. And now all of a sudden you have to come up with the liquidity or change your terms with your customers who, again, may be facing their own liquidity problems in their business. So the difference with liquidity is that it's something of value built up within your business that you have access to. Whether it's a savings account, an investing account, there's different life insurance policies that build cash value. There's all kinds of different things that you can have that will create your own controllable asset within the business that gives you this greater resiliency. The reason why we called the book The Business Fortress was we wanted to create the idea of this strong, defensible place. And we thought, how can we create a story and messages that teach people how they should be thinking about their business and how they could think about making it stronger and more resilient and better able to weather storms over the course of time. And if you've ever built or visited one of these real castles or fortresses, especially over in Europe, they often have a story that says they took several hundred years to build, right? These things don't go up at the drop of a hat. And so that's the whole message is over the course of time, you want to be profitable and you want to not put every last nickel into growth or advertising or trying to figure out a new way to spend or buying something because your accountant told you might save some taxes with some depreciation. You want to actually use the cash flow to create a stronger, more defensible business. Because when things go bad for for the market in general, but for your competitors, this is when the big opportunities come up. If someone goes under and you are able to take one of their customers or maybe buy some of their equipment on the cheap or something like this. Over the course of my career, I've met so many people who played really carefully with their money, and they've got stories of the time when they were able to take advantage of some great opportunities, unfortunately from someone else's hardship, usually because of a general downturn in the economy.
So you said a lot of things there.
Yeah.
First and foremost, for all our clients, when they go for lines of credit, I'm like, send me the contract. I want to read it. And the reason I want to read it is because I want to understand if it's callable and under what terms is it callable. People these days, I don't think realize that, like when we hit 08, all the loans were called or partially called and all of that. And so that creates another issue. It could be a global economic issue. It could be a local issue. And so we always want to know what are the bank's terms and under what terms can they call your loan. Post 08, I was buying houses that compared to today's prices, oh my God, I was paying pennies on the dollar for today. We were paying pennies on the dollar for that market, but compared to what they sell for today, it's unbelievable. But we took care of it because we had the cash.
Yeah. I don't think people really understand what it means when there literally are no buyers in a market. Like you were able to take advantage of deals like that because you were probably one of the only people even showing up to come and take a look at the houses.
In the beginning, yeah, there were not a lot of buyers. We also understood what other people wouldn't buy that we would. So we created a buy box that we were like the only people in the buy box. So if you had that, we were the people who would buy it. Almost nobody else would. So that was the thing. We had the cash. We could close as fast as they wanted. And that was when the opportunity was there. But that happens at a global level economically. It happens at the singular level or at a local level or an industry level. So there's a variety of different ways you can get hit with this. This is why I like to have businesses keep 6 months of all their expenses in cash. Yeah. They're like, you want me to have that much cash sitting around? Yes, I do. You will sleep like a baby.
So when I talk about cash and savings, people often will respond with, but I need to put my money to work. And the line that I deliver to people is that a bank account with several months of expenses in it is buying something. It's buying sleep because it allows you to actually have that allows you to keep the anxiety and the fear away because regardless of what happens, you can pay your bills.
But right now, banks are paying at the peak, they were paying over 5%. Right now, they're paying 4%. So it's not like you're getting nothing. You're still making some money. 4% isn't great, but it's there. And there are products out there, and maybe one day we'll have somebody on where they will run what we call a sweep account. they'll take your money. Let's just say you're running with a couple 100,000 in the bank every month, because that's just your normal money coming and going. You're a builder or a contractor or whatever. They'll actually sweep your excess overnight, like the big companies do. And so your bank will always have 30,000 in it, but the moment you hit it with a larger check, they'll sweep the bank money right back over. They'll cover your check. And in the meantime, just your working capital is earning interest on top of the extra. So that also is phenomenal. The other thing that nobody talks about, and it depends on the business model, growth crushes liquidity.
It does.
So growth, you use leverage to grow, and then growth crushes liquidity, and liquidity crushes your leverage. And that's where the bank goes, no more money for you. And your P&L looked phenomenal.
I'm glad you brought this up, because I actually have a client who was looking at one of his businesses was going to bid on a contract. And the ultimate payer was a hospital and insurance companies. And so they knew on average it could be 90 to 120 days before everything was settled, because a lot of these invoices had to go to one place for partial payment, then the balance had to go to another place depending on policies and co-pays and all this kind of stuff. That the billing was very difficult and complicated to manage. But they knew it was going to be 90 to 120 days before everything was covered. And so they figured out, what is it going to cost us in order to actually deliver this service. Capital expenses, they were going to have to buy a couple of vehicles. They were going to have wages for 4 or 5 employees doing this work. And that's when he realized, I actually need to invest in accounts receivable. And that thinking, that terminology, is something that a lot of new or smaller entrepreneurs don't ever really think about. But if you're going to grow your sales for a lot of businesses, if you're going to extend credit to your customers, you actually need to find money to invest in accounts receivables in order to take on that new customer. If you start the work and you don't think about it, you end up in a cash crisis because the money doesn't come in time. And this is what you're saying. Like, you end up in a cash crisis, and then you end up borrowing, and now you've got finance charges on top of that, and growth requires a plan, and you can't just keep borrowing every time you want to grow, because you end up with a weaker and weaker balance sheet. One of the sections of the book, I actually talk about debt to equity ratios and why bankers look at debt to equity ratios when they're looking at a business. I try to give people an insight into how a banker or maybe even a big landlord might look at their business. For a lot of small business owners, they've never even thought of these kinds of things. Why their balance sheet is important. We handle a lot of financial statements when we're working with business owners who want to figure out what their business is worth. And I would say 80% of the time, the P&L is pretty accurate, but the balance sheet is way off. They don't look at it. There's a lot of inaccuracies, and they don't understand the value of it at all.
That's where wealth is built, on the balance sheet. And so I would agree with you. I don't think accountants even fuss over the balance sheet, even though that's their realm. They don't, and the owner's not looking at it, so he's not challenging it. And the thing with the balance sheet is you have to learn how to read balance sheets not as a standalone.
Yep.
That's where everyone gets it wrong. Oh, it's a standalone. No, it's not. I want to see the balance sheet comparative month to month. And I want to find out where Waldo is, what changed and why, and how come it changed, and what is the driver of that. And that's what we're constantly looking at. What is happening there? Because business owners will invariably say, my P&L looks great, but I have no cash in the bank. Yeah, it's on the balance sheet. And there's a variety of reasons of why it gets lost. You were talking about accounts receivable. What we talk about is an accounts receivable policy. The first part of an AR policy is to call when the invoice is delivered. Hey, did you get my invoice? Is it in the correct format? Did I deliver it to the right place? Is everything good? How does your payment policy work? If you don't happen to know that. The second thing is, the other side of AR is AP. So your AR is someone's AP. The person working AP gets nothing but nasty people calling them all day going, where's my money? You buy the AP person a cup of coffee, I guarantee you your checks get cut first. Go be nice to AP on the other side. Learn how to get paid. Like, this is part of the game that you have to work out and have to make to the positive side. And so there's a million things here that I know for our clients, we are constantly having these conversations of, hey, how are we doing this? What's going to happen here? Hey, let's be proactive there. And we just smooth the road for them so that they don't have to get punched in the face as much as we can help it.
There's a case study in the book, and it's based upon, I do this special for my podcast where I do these special conversations over Christmas time at a discounted price. They're real consulting calls, but I discount them so I can eventually release them publicly. And I had one gentleman call me 3 years in a row. And the first year, he had just acquired a commercial landscaping company, and he did not account properly for the operating capital he was going to require. And so it was a bit of an emergency. So I worked with him to figure out an emergency plan to survive. The next year he called in and things were going really well, and he managed to save up a little bit of money. He had, I think it was like $80,000 or something. And of course, what he wanted to do is he wanted to take that money and use it as a down payment to go buy another business. And I said, look, danger, caution. This is not the time to do this. You need to take this opportunity to have this profit, build your balance sheet. He took on some higher cost debt when his emergency plan. So, make sure that's all paid off. Make sure you have a plan B if there's a slowdown of any kind. So I cautioned him against doing the expansion, which you mentioned earlier. There's this hoopla in the business community about leverage and growth and leverage and growth. And that's what he was buying into in that sentiment. He was like, I have this opportunity because I have this money. I can go leverage another loan. I can grow my business, et cetera, et cetera. Growth, growth, growth. Well, in the third year, he called back again. Several of his large institutional clients had left him, and he was in a bit of a sales crisis. But it wasn't a cash flow crisis because he had that extra money. And he called back the third year just to say, look, I'm so happy I didn't put myself into that position that I was going to, because I basically was building a house on sand, as it were, right? And so the resounding message of the book, and the discussion that we have in the book, is about creating a stronger and stronger foundation so that you can survive when things like that happen, and that you can build a stronger footing for moving forward, and ultimately give yourself even more choices in the exit. Here's a fact that most people don't like to hear. 80% of the businesses listed on the big online marketplaces actually don't sell as going concerns. They don't sell as businesses. Maybe there's some assets that can be sold off or what have you, but they don't actually ever sell. And so one of the biggest bits of advice I give to people is build wealth inside and outside the business, and make sure that you have a plan B if you cannot exit the business and sell it to someone. Because a lot of the time, that is the actual result at the end of a person's career of ownership, is that they just can't sell.
I'm with you. I'm also a big fan of Mike Finger, Mike, that's all he posts about on LinkedIn all the time, is the reality of the business situation. And that's why I want people to take the cash flow from the business and build alternative investments outside the business that they are secure. And that's why when we work with our clients, we don't just look at the business. We will actually look at their personal finance as well, their personal taxes, and how everything goes together, and help them make the appropriate choices of what are the better options. Is it better in the business? Is it better out of the business? What are the different ways to look at it? And how do we build wealth? Because at the end of the day, that's what this is all about. How do we build wealth? It doesn't matter where the money is. Let's put it in the place that it works best. So if people would like to learn more from you, remind them where you're located and how they can find you.
Sure. I've got a YouTube channel and a podcast. All you have to do is look up David Barnett Small Business, and you'll find me right away. The new book is called The Business Fortress. You can find it on Amazon. And davidcbarnett.com is my blog site. So any kind of Google search with David Barnett and small business will find all of these things very quickly. I've got a bunch of books on Amazon. The Business Fortress is just the most recent one.
Thank you so much for joining us again.
Thanks, Rocky. It's always a pleasure to stop by.
Thanks for listening to this unedited video of the Profit Answer Man podcast. If you'd like to catch the full episode and learn more about what we do, check us out at profitcomesfirst.com. We also go through the Profit First book in each and every chapter in the beginning episodes of the podcast, so check those out as well. Thanks for listening, and here's to you having a more profitable and growing business.